and welcome back to your CPA School. In today's lesson, we are going to discuss an important topic in financial reporting, discontinued operations, specifically when a company makes a strategic shift in its business. This concept frequently appears in FAR exam questions, and understanding the logic behind it will help you analyze financial statements more effectively. So let's begin. In this scenario, this is a dotted line. It is called separation line. It separates division B from the main operation. This is the continuing operation, and this indicates discontinuing operation. The dotted line separates between these two. It indicates the discontinued operations should be reported separately. Let's understand the definition. A discontinued operation occurs when a company disposes a component that represents a major strategic shift in its business. For example, a company may decide to exit an entire geographic region or sell a major line of business. This is not a routine transaction. This is a strategic decision that changes the company's future operations. Because of its significance, accounting standards require that this information be reported separately in its financial statement. It is very important to understand the distinction here. A discontinued operation is not the same as selling a single asset. For example, if a company sells a machine, that is simply a gain or loss on disposal of an asset. But if the company sells an entire division, that is considered a strategic shift. The key idea is that the disposal must involve a component of the business that has its own operations and cash flows. Only then it can qualify as a discontinued operation. Now, let's talk about how discontinued operations are reported in the financial statements. Under US GAAP, discontinued operation must be segregated on the income statement. This means they are shown separately from continuing operation, just below the income from continuing operations. Why? Because investors and analysts need to clearly understand which part of the company will continue in the future and which parts will no longer exist. Another important rule is that discontinued operations are reported net of tax. That means income statement shows the after-tax impact of the discontinued operation. A key concept in this topic is held for sale. A component is reported as discontinued at the earliest point when it is classified as held for sale. This means management has made a clear decision to sell the component, and certain criteria have been made. Once a component is classified as held for sale, the accounting treatment changes immediately. The classification signals that the component will soon be removed from the company's operations. To classify a component as held for sale, all 6 criteria must be satisfied. These criteria ensure that the company is serious about the sale and not just considering the possibility. For example, management must commit to a plan to sell the component. The component must be available for immediate sale. The sale must be probable and expected to occur within a year. When these conditions are met, the component can officially be classified as held for sale. Once a component is classified as held for sale, an important accounting change occurs. Depreciation stops immediately. Why? Because the asset is no longer being used to generate revenue through operations. Instead, the company expects to recover its value through sale rather than use. Therefore, we stop recording depreciation from that point forward. Do not calculate depreciation for the months leading up to the sale. The examiner will try to trick you into calculating depreciation for the months leading up to a sale. Don't fall for it. This is one of the most frequently tested mechanical rules in this area. Now let's discuss something called incremental loss logic. Sometimes the disposal process takes place over multiple years. For example, the company may recognize an impairment loss when the asset is classified as held for sale. Later, when the asset is actually sold, the company may recognize additional loss or gain. Each amount must be reported in the period it occurs. This ensures that the financial statement reflects the economic reality of each period. The exam wants to see if you understand cumulative versus incremental measurement. You only report the additional gain or loss in the year of sale. Let's take a look at simple example. Suppose a component is classified as held for sale in year 1 and the company recognizes an impairment loss of 300K. Then in year 2, the component is finally sold and the total loss from the transaction becomes 400K. This means that an additional 100K loss must be recognized in year 2. The key idea is that the losses are recorded incrementally as they occur. Valuation and the period of occurrence rules. In year 1, impairment recognized 300K, asset written down to fair value. In year 2, the asset sold and the total loss on sale is 400K. The incremental loss logic, meaning that the only incremental loss 100K, 400K minus 300K is to report in year 2. In this case, you need to understand the reporting formula. Operating loss year 2 plus incremental disposal loss year 2 times 1 minus tax rate equals to net loss from discontinued operations, which is to report in year 2. Multi-year trap. This red bar shows year 2 operating loss. So how much is that? 400K. The second red bar shows incremental disposal loss, 100K. How to calculate? 400K is the total loss and 300K year 1 impairment. So this is incremental disposal loss. When it is occurred? In year 2. So total loss, operating loss plus incremental loss. The 500K plus 100K equals to 600K. And this is pre-tax loss. And you need to report the net of tax. So if tax benefit is 30%, so 70% is your loss. So 70% of 600K net loss reported. How 70% of 600K equals to 420K. So these 420K should be reported. When? In the period table. No smoothing. Let's summarize the key concept. You see, discontinued operation, let's summarize concepts, definition, distinction, reporting, held for sale, multi-year trap, reporting formula. So definition. Very simply, dispose of a component that represents a major strategic shift. Definition, a strategic change from routine change, not the routine change. Reporting, reported separately, just below the income from continuing operations. And the amount should be net of tax. Held for sale must meet all 6 criteria. What is the criteria? Management commitment, immediate availability, active search, 1-year timeline, active marketing, unlikelihood of change. And depreciation stops immediately. Multi-year trap, apply incremental loss concept. Reporting formula, operating loss plus incremental loss times 1 minus tax rate equal to net loss from continuing operation. Now time to test our concept, application of concept. So here is a problem solving. Always focus on call of the question. Here is the call of the question. This is regarding income tax. What amount of net gain or loss should be reported in such comparative year 4 and year 3 income statement? So the call of the question is what amount of net gain or loss for year 4 and for year 3 that should be reported in income statement. So now during January year 3, SAF Corporation agreed to sell the asset and product line of its footwear division. The decision represents a major strategic shift for SAF and will have a significant effect on its operation and financial results. The phrase major strategic shift always used for discontinued operation. The sale was completed on January 15 year 4 and resulted in a gain on disposal of 900,000 USD. Footwear's operating losses were 600,000 for year 3 and 50,000 for the period January 1 through January 15 year 4. So this is a multi-year trap, right? But here is no income tax calculation. Remember, according to the GAAP, discontinued operation, either loss or income, whatever the amount, it should be reported on net of tax. But here is you need to ignore the tax and no tax rate is there, so you don't need to consider anything. It is much more easier. So year 3, if you see 600,000 operating losses and there is no other information. So in year 3, you can find 600,000 losses. Through this bracket, it indicates it is losses. So C will be the answer. Primarily, we can understand. But we also calculate the for year 4. So year 4, there is a gain on disposal 900,000. And there is the operating loss January 1 through January 15 year 4, 50,000. So 900,000 is the gain and 50,000 is the operating loss. So what is the net gain? 850,000. Actually, it should be shown is a positive figure. If you see here is a 50,000, no bracket is there. So it indicates gain. So C will be the correct answer, right? That concludes our discussion on a strategic shift and discontinued operations. This topic is important not only for the CPA exam, but also for understanding how companies communicate major strategic decisions with investors. If this lesson helped clarify the concept for you, please like the video, subscribe to the channel, and press the bell icon so you don't miss the future lesson. At your CPA School, we believe one simple idea: concept first, confidence all.